Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss a variety of the most common retirement plans. In exchange for substantial tax benefits, investors need to navigate a myriad of rules and restrictions. Aaron and Trishul discuss small business plans, including SEPs, Simples, and solo 401ks. They then dig into bigger business plans, including 401ks, 403bs, 457s, and TSPs. By the end, you'll understand how non-Roth after-tax voluntary contributions can allow you to shelter close to $60K a year through a Mega-Backdoor Roth conversion. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So last week, Trishul and I talked about some of the benefits of a financial planner and the ways we help clients that weren't related to investments. And one of the big ones that Trishul brought up was managing retirement plans. And the idea here is the IRS and tax code provide a lot of tax benefits to saving for retirement. So your investments could be the same. You can have all the long-term compound growth that Trishul just absolutely loves. But if we can get it to be tax deferred, then we can even increase those benefits. And then if we can get either some parts to be tax-free or pre-tax, we can have tax deductions on money going into retirement plans, or we can have growth to be tax-free through Roth. That's even just more than just icing on the cake. That's just making things look so much better. And in exchange for all of these awesome tax benefits, the IRS and the tax code have put in a lot of rules. There are contribution limits. There are income restrictions on contributions. There are income restrictions on deductibility. There are both individual plans and employer-sponsored plans. So today we're going to try and go deep. And honestly, we started kind of planning for this episode. We realized there's going to be so much. I don't know if we can get to it because there's so many little edge cases, so many things to be aware of, but we're going to try and give you a lot of information on all the ways retirement plans can help your investments from a tax deferral, tax-free perspective. So we've gone through Roth IRAs in the past and kind of difference between Roth IRA and traditional IRA, and that'll come up again a little bit. But we're going to start with small business retirement plans. One, because there's a few of them, but also this tends to be where advisors' help really comes into play. That if you are a small business owner, you get to decide which retirement plan you implement for your business. And so because you have that decision in front of you, there's so many more factors that you need to consider. Whereas if you have an IRA or a 401k through work, either the IRS rules are the determining factor or the 401k plan determined by the company is the factor. So Trishul, why don't you start off? What are some of the different small business retirement plans before we get into the other types of retirement plans?
Right, so these are retirement plans that are beyond the individual retirement accounts, individual meaning tied to a person. These are plans that you would typically have within a small business structure. So beyond just your traditional IRA and your Roth IRA, these types of plans are catered towards businesses that either have a sole proprietorship, meaning just like a husband and a wife, or just one person, a solo practitioner, or just a small business with a handful of employees. And the three most common small business type plans that occur time and again are the SEP IRA, the individual 401k, and the simple IRA. And yeah, we'll certainly go through the nuances and differences among these three. But at a high level, what we kind of want to think is we're going to look into, for example, what are the contribution limits for the employees? So like how much can they put into their plan? And we also want to think about what are the contribution parameters for the employers themselves. So these have different sets of rules for these three types of plans. And then, there are other nuances in terms of when each of these plans makes sense, and we'll talk about that as well. But at a high level, yeah, these are the three that you'll likely see in the small business world.
Okay. One thing I want to kind of quickly address, because this is a little bit of history of retirement plans, because some of these numbers in terms of contribution limits can get pretty big. A lot of these were evolved from pensions. And the reason I say that is if you were a company in the 50s or 60s and you want to offer pensions to your employees, and you say, okay, it's going to be based on your last 5 years of service, as long as you worked here 10 years, and based on your age, and there's actuarial calculations. So the company saves enough money into the pension. The company gets a tax deduction on the money. It goes into that pension because it's an employee benefit, just like any other deductible expense. And the contribution amounts were almost determined by the employee's age and their level of income and kind of what the benefit you're going to provide was. So the idea is if there's an employee who's 30 years old and your amount you're putting in can grow for 30 years or 35 years before they take it out, you don't need to put in as much. But if the employee's already 60, the company has to significantly fund that pension to make sure it can provide the benefits. It only has 5 years of growth before it can pay out that pension. And so because it's a legal obligation of the company to make sure that there's enough money in the pension plan, they were allowed to put a lot of money into pension plans. It was on pre-tax to cover that pension benefit. Then over probably the 70s, 80s, and 90s, there was a big kind of shift from what are called defined benefit plans to defined contribution plans. But a lot of planners and accountants and companies were able to realize we can still take advantage of those defined benefit rules to put in a lot of money on a pre-tax basis that gets paid out over a long time. So our conversation today isn't going to be about pensions and cash balance plans and profit sharing and KIOs and like rabbi trust, but those are just a lot of different types of retirement plans that have slightly different tax rules. But it's really good context for understanding. It used to be that companies could put a lot of money into these plans on a pre-tax basis, and the IRS has started and tax authorities are adding some restrictions on top of that. So that's kind of why it gets really complex. Is you could have a situation in the past, go back 5 decades, where an executive, they're putting in $300,000 or $400,000 on a pre-tax benefit to benefit, or a pre-tax basis to benefit that executive's pension because they need to fund it that much. And the IRS is kind of again started to place some restrictions on that. So that's going to inform where some of these restrictions have come into play. It also kind of informs why it has gotten so complex. But why don't you go and start kind of describe some of the benefits and differences between the 3 more common small business retirement plans you see now: the SEP IRA, the simple IRA, and the individual 401k. It's also called a solo K or solo 401k or a unit K. I've seen those are all labeled the same thing. So individual 401k, solo 401k, and unit K are all the same thing.
Right. Yeah, and it's good to make that distinction. So all these 3 are defined contribution plans, meaning there's a set amount of contributions, meaning how much you can put into these plans that are defined. It's laid out. instead of the analog, as you just mentioned, Aaron, of a defined benefit plan, where it's not the contributions that are fully defined, but it's the benefit that you get, when you need the money, like 20, 30 years after you're done working and you retire. That's defined in a defined benefit plan. So in terms of the contributions that are defined, well, first, let's just talk about the key advantages of each of these types of plans. So for example, with the SEP IRA, it works well for business owners who prefer to provide a retirement benefit to all employees, including themselves, by making employer contributions. So that's one of the key advantages. Now, to contrast that with the individual 401k, now the notion here is it's an excellent way to maximize contributions in general. And that's because you can contribute as an employer and as an employee. And then you have the simple IRA. And as the name suggests, it's a good starter plan to just kind of get the ball going. And it encourages contributions from employees. Now, let's talk a little bit more about the nuances in terms of what the employees can and can't do and what the employers can and can't do for each of these plans. So for the SEP, it's mainly for self-employed individuals or any businesses that currently don't have a plan. So you can't have some other type of plan. And generally for the employee, in order to participate, you must be at least 21 and you must earn at least $600 a year in the current tax year. And you must have worked for the same employer for at least 3 of the past 5 years. So that in itself is a pretty good restriction. But basically, the employers can choose less restrictive requirements, but that's kind of what the standard is. So there's a bit of a hurdle to get into a SEP. Now, in terms of the funding responsibility, though, for the SEP IRA, generally, the employers only contribute to the SEP. So now the way you kind of think about this is if you're a small business owner, you're going to factor in this contribution in terms of how you want to compensate an employee. And the employee is going to understand that some of their compensation will come through their wage, but some will be contributed on behalf of the employer to the employee. So the drawback, though, as you can surmise, is that the employees can contribute through a SEP IRA through payroll deduction. However, that they may be able to make traditional IRA contributions into the plan, but at that point, you might as well just make your traditional IRA contribution into your traditional IRA.
Yeah.
So in terms of contribution options, the employer can decide whether or not to make contributions from year to year. So that's an important advantage for the employer because some years just may not be good. And you want to have that flexibility in case, profit is down or revenue is down and whatnot. So this is a stipulation in terms of the SEP IRA where depending on how the business is going, you might change as the employer how much you contribute into these plans. Now, for the actual employer contribution limits, it can be up to 25% of the employee's compensation, or a maximum of 58K actually for 2021, whichever is less. So that's a good amount of an employee's compensation. So 25% up to 58K is not so bad. So contributions are deductible and again, aren't required each year. So these are pre-tax contributions basically.
Okay, and then
yep.
key is that the employer needs to contribute at the same rate for all employees, including the owner. Is that correct?
I believe so. That there's a good amount of fairness that goes into these types of plans. What the government does not want to happen in terms of these types of benefits is to say that, the employer can max his contribution out and then just give nothing to the employees. So in order for these plans to meet the qualifications for being compliant, these are standards, I believe, that are set by ERISA. The goal is to make them fair according to these guidelines. And a lot of them relate to the notion that, you can't give compensation to, or give a substantially higher amount of compensation to highly compensated employees, so that there's limits to restrict that.
Okay, so if the owner puts in 10% of his own income, so if the owner decides that the business is going to fund 10% of the owner's income into the SEP, also has to do 10% for the employees, that would be considered fair. You can't have a situation where the owner is trying to contribute up to that 58K number and they're maxing out their 25%, but not doing it at the same rate as the rest of the employees.
Yeah, and these rules do get a little more complicated with some of these other plans, but I believe that that's the flavor for the SEP.
Okay.
So again, not so bad, because you're an employer, you have a business, you want to incentivize your employees, and you can, say in your package, each employee will get, like Aaron just mentioned, 10% of their compensation will go into a pre-tax account, meaning their overall tax burden, if that money were to go, directly as a salary, would provide an advantage of they don't have to pay taxes on 10% of their income, and that gets automatically put away for retirement.
Okay.
So not so bad. And the next one we're going to think about is the individual 401k. As Aaron, you mentioned the solo, and what was that third name?
Unit-K.
The Unit-K. So this is actually meant for self-employed individuals or businesses with no common law employees. So the point here is you don't have employees. It's just like a mom and pop shop, or you're a solo practitioner. And in this plan, your goal here is to maximize your contributions. And you can do this by making employer and employee contributions. So now, in terms of the actual contribution numbers, on the employee side, you can put your 19,500, similar to that contribution limit you might understand for just 401k if you're employed at a larger company. So that's that 19,500 number on the behalf of an employee, and that's a pre-tax number, meaning you put that in and you don't pay tax on that, or you get a deduction for that amount. And the goal here, of course, is you have to make more than 19,500. This has to be earned income that you're putting in. Now, on top of that, the employer can make an additional contribution up to 25% of compensation. Again, the cap here is you can't exceed the 58,000 number. And that 58,000 number has to include the employee contribution as well. But you can see how here, as compared to the SEP IRA, if you're just a mom and pop shop, you could potentially add some more income, because you get that automatic 19,500 if you just earn 19,500, and then you can start digging into that 25% of compensation number. Whereas with the SEP, you're just digging into that 25% of compensation number. So you'll get it'll take a higher amount of income to max out, or it will take it'll take a higher amount of income to max out your SEP IRA than it would your solo 401k.
So if I have my math correctly, I understand this. If the business income kind of after expenses, so I forget what I don't think this is EBITDA. I think this is net revenue. I get the business rates for it, but it's revenue minus expenses. This would be also kind of earnings before owner compensation, I think. So it's the idea is like, as a small business, you're kind of deciding how much is employee pay that has payroll taxes, how much is owner's profit, which is paid out of dividend. But let's say revenue minus expenses is $150,000. Under a SEP IRA, you can only contribute 25% of that. So it'd be 37,500. But with a solo 401k, it'd be 25%, 37,500 plus the 19,500 you make as an employee. Does that sound correct?
It roughly does. So we'll throw in the show notes, have a nifty chart that just kind of shows, based upon different net profit levels, how much you can contribute into these plans. And, long story short, for most net profit numbers, you can put more into the individual 401k than you can into a SEP.
Okay. So yeah, we'll need that. But okay, now, yeah, as soon as I said that, it's like, okay, but now you have to make sure you include all the payroll taxes of the employee contribution, and if you're going to do withholdings from your own salary. So yeah, you need to make sure you actually pay the taxes. But I guess, okay, we'll leave that to the show notes. But I agree with the concept. In general, if you're a sole proprietor or an S corp, or it's just the owner is the only employee, or it's just husband and wife or spouses, then you can usually contribute more to a solo 401k than you can to a SEP.
Right.
Okay, I'm on board.
Right. So it's not a bad thing to consider. And again, you did have the option to contribute as an employee with the SEP, but you're eating into your traditional IRA contribution limit, which it's, kind of sounds silly. You're not really getting an extra amount. You're just pulling away from a contribution you could already make with the SEP, whereas you don't have that issue with the solo 401k.
Oh, that's a good point. So SEP is considered an IRA from that perspective. So it does go against your total IRA contributions, whereas the solo is a 401k plan. So
yeah, for the employee contributions, yeah, and that's kind of whereas the 401k has 401k in it, and that's why it has the 401k limits that are much higher than the IRA limits.
Yeah, which is a whole separate issue we're not even going to go into, of why are 401k limits different than traditional IRA limits. But that's a different type of conversation that we may never get into.
Well, we might need to table that point, but there is a lot of backstory here that kind of pulls all these numbers to where we are today.
Okay. And then what about the simple IRA?
Okay, so the simple IRA, as its name suggests, is kind of like a starter plan if you just want to get something out there that's kind of quick and dirty. So what this tries to do is it tries to encourage contributions from the employees this time. So again, SEP, employer, individual 401k, employer, employee, and then simple is employee. Now, with the simple IRA, it's for self-employed individuals or any businesses with 100 or fewer employees. So again, you're not going to have a big corporation with this type of plan. Now, there's no age restrictions on the simple, so that might be one reason why this is more common with some certain types of businesses, meaning if you have a lot of employees who are younger than 21, well, then the SEP is not going to work. So the simple might be the best way to go in this type of situation. Now, you also, as an employee, must have earned at least $5,000 during any 2 prior years, consecutive or non-consecutive, and expect to earn at least $5,000 in the current years. And then, that employers can also choose less restrictive requirements, but that's the boilerplate requirement. And then in terms of the contributions, the employee payroll contributions can come from basically a limit. And here's how it works. So option 1, you can have a dollar for dollar match of the employee contributions up to 3% of the employee's compensation, which can be reduced to as low as 1% in 2 out of 5 years. Okay, so that's the first option. Option 2 is you can contribute 2% of each employee's compensation on behalf of the employer. And the maximum compensation used to determine this is $290,000 for 2021. So there is a match option, but these numbers aren't that high, basically 1 to 2% or 1 to 3%. On the employee side, this is where, the bulk of the funds will go into this type of plan, into the simple. So for 2021, it's basically 13,500, and you can't exceed 100% of compensation. So employees aren't required to contribute. So this is completely optional, but basically you can think about it like a 401k plan, but instead of having the cap at the 19,500, the cap is 13,500.
So it sounds like it's uh, just not quite as beneficial as the 401k, but because it's significantly easier to set up and there aren't the age restrictions, that this is, like you said, it's really designed to be that quick and dirty. It's logistically very easy, but not quite as beneficial as a 401k.
Right. Yeah. And the notion here is, again, if you have younger employees, it might make sense. If you have employees that aren't looking to put that much in but want to get something in, like 13,500 to a certain class of employees is a lot of money. So it's just something to consider depending on the type of company you have. And as far as the different flavors, each of them has catch-up contribution options for the employee. For example, with the SEP IRA, again, this is going to eat into your traditional IRA, but if you are over 50, you can put an extra $1,000. Again, not recommended to do it here because you could just do it in your traditional IRA. Now, however, there is that catch-up contribution for the 401k or the solo 401k, and that's an extra, let's see, $6,500 for 2021.
So you can get up to $26,000 total if you are age 50 or older.
Right, into a simple IRA.
No,
sorry,
to the 401k.
solo
401k,
solo
yeah.
401k.
That's just the employee side.
Yep, just the employee side. Yeah, these are all for the employee, the catch-up contributions. And then for the third one for the employee, for the simple, is you can add an extra 3,000.
Okay. So that was the SEP IRA, simple IRA, right?
Yeah.
Simple IRA and solo 401k.
Right.
Okay. So I have the reason I know about the Unikay is I actually do have a client who had a Unikay previously set up before he came to work with me, and so just in conversations with the client, sometimes I'll say solo 401k, and he'll kind of come back, "You're referring to my Unikay, right?" Just like that's the nomenclature that's in his mind because that's the way it was set up. So it's one of those little things of I need to remember the different details and how clients think about their own things.
Right. Yeah. And so if you're a small business and you don't have employees and you want to maximize your contributions, the insight here is you want to give a strong weight to the solo 401k. So pound for pound, you're likely going to be able to contribute as much or more into this type of plan than you would with the other two.
Yeah, I think this is probably a good kind of transition to understanding with the 401k compared to the SEP or the simple, there are now administrative requirements that they're just getting a little bit more difficult, and this informs the decision, especially for small business, where the actual costs of the administration come into play, where you need to have a plan document, you need to do some regular compliance. There's things like if the solo 401k has a balance over $250,000, there's an annual filing requirement. And so this is kind of why SEPs and simples still exist at the small business level, is that they are just administratively easier and there are fewer plan costs. It's also why these types of plans are more common than a defined benefit plan, because there the administrative costs get really expensive. You have to actually hire third-party administrators and actuaries to do those calculations for you. So that goes along with One, why these are more popular than defined benefit plans, but also kind of why, even though we say the solo 401k works out better than the SEP in most cases, you still have to consider what you're going to contribute. Could you do that with a SEP? Could you do that without the administrative costs? So that's kind of, I feel like most of these plans kind of lie on a spectrum where something like the traditional IRA or the Roth IRA are probably the easiest to set up and the cheapest. There's no administrative cost to opening a traditional IRA at any custodian or bank. Same thing with a Roth IRA. But any plan that gets more complicated, there's certain benefits and different calculations, but it definitely gets more expensive and more onerous from an administration perspective. So that's why these employer-sponsored plans in particular are more on the spectrum, closer to the ease of use for setting up, as the traditional IRA and Roth IRA. They're farther from the larger 401ks and defined benefit plans.
Yeah, that's right.
So,
and yep.
Go ahead.
Well, what kind of goes through my mind is I feel like I'm going to climb on my soapbox for a minute. I feel like the government could make things a lot easier by just increasing the standard IRA contribution limits so that it just encompasses the contribution limits for these plans. And then you don't need these plans anymore. Like each employer doesn't have to figure out what they need to do. They can just say, okay, just put that money in your IRA if you want to, and I'll contribute to that IRA if you want to.
So I agree. I almost completely agree in sentiment. That, like, why is the contribution limit for 401k 19,500 for the employee and only 6,000 this year, 6,500 this year for IRAs? Right. That one I don't even get, because there are other things in place, like an income restriction on Roth IRAs, where it feels like the government has decided, oh, the Roth IRA benefit's too good, so if you make too much money, you don't get the Roth benefit, which is completely undone by the backdoor Roth, which is also just an annoying thing. Like, just like, if you're going to allow the backdoor Roth, just allow the first Roth IRA contribution. But it feels like the government is acknowledging the extra tax benefits to individuals at these really high incomes might be too much. So we need to put some restrictions in place. And that kind of feels what they're trying to be fair. I get that part. But then to keep the traditional IRA and Roth IRA limit so much lower than all the other plans completely undoes that. I feel like if you put the Roth IRA and traditional IRA limit at $1 higher than the 401k contribution limits, all that money is going to the IRAs instead of 401ks.
Right.
Okay, sorry. I'm with you. It's kind of, I almost get why they place some restrictions to be fair, but then they completely screw it up and it's not actually fair.
Yeah, and I'm gonna put my tinfoil hat on as well.
Is it lobbying?
I think so. I mean, okay, so we've mentioned this in the past with employer-sponsored healthcare plans, right? The fact that each employer now has to figure out what's the best solution for the employees based upon their age and blah, blah, blah. It's creating the most inefficient system possible, where instead of having one standardized approach, each employer has to figure out, okay, what's the best way to come up with a plan for my 100 employees, right? Instead of everybody just going to the same marketplace, now you have this very fractured marketplace of of options. Well, I think the same thing is going on with these employer-sponsored plans. If you're an employer, now you have to figure out from this fractured market what type of plan you want and get an administrator and overhead and ERISA and blah, blah, blah. Whereas if you're a small business owner or any business owner and the government just said, okay, employees get income, they can put their 19,500 into their individual 401k, individual IRA, then every employee doesn't need to scatter around trying to figure out their own customized solution. I think it just adds an incredible amount of overhead to the system where the solution is already there. You just need to increase the income limits for the IRAs, and every employee now has access to a great plan.
Yeah, it's that is one thing I like to see. It's even if you have access to a 401k, the coordination between 401k and IRA, like you said on the healthcare thing, if every person is averaging 1 to 2 days working days per year dealing with health insurance, and I have more bills on my desk here because I need to call the insurance company, we can increase GDP by 1 to 2% just by removing the days spent dealing with health insurance. This feels like it's not quite that scale, but it's still pretty close.
I think so. And I just don't think it's fair. Like, some employers just haven't got around to setting a plan. Now, why should those employees not get the benefit as compared to the same exact job with another employer who has their act together?
And also, another small thing is, like, there's a fine line between employers kind of waiting to see if the employee is going to kind of stick around long enough that they want to reward them and make them a part of the plan, and they're a good employee that they want to kind of provide that benefit, versus choosing the plan that's intentionally restrictive so that they don't have to make contributions on behalf of the employees. Because there's a variety of disqualification rules where if they're working part-time, if they're like you said, they haven't been working 2 of the last 5 years for you, if they're not the same company, so if you imagine a variety of industries that have slightly higher turnover, it's pretty easy to imagine that the management and owners can do these retirement plans and get all the benefits and not have to provide much. And so I'm not saying that they're going to be acting nefariously, but it is a fine line between trying to provide extra benefits for employees who won't stick around versus intentionally restricting from those employees.
Yeah, I agree with that. I think, my take on the insurance company thing is I think it just increases costs because you have every single business trying to figure out a really complicated set of rules that doesn't really pertain to their business. And I think the same thing kind of applies here, where now you need to become an expert in all of these types of plans to figure out which plan makes the most sense for your business. And then you also have to administer that plan. And that adds another layer of expense. Whereas, there are retirement plans that everybody likely has access to through, these individual accounts. They're already there. And
yeah. In fact,
they're already administered.
Just change the dollar amount they can put in.
Yeah, right.
That would be, be like one of the easiest things they could do.
Right. So, another few percent on GDP, I'd say.
Okay. So like that, I guess the benefit probably would not be as big as with the healthcare plans. I think that's a much bigger problem. But just that idea of it's a really, really easy fix that helps a lot of people.
Right. Well, see, I think in terms of access to these plans, I think everybody should be able to get the access like they do with an IRA account. That contribution limit is 6,000, but just add in that 19.5 that you could get if you happen to be with a nice employer. So you get 25,500 for everybody.
It doesn't even have to be that number. Like, as long as it's the same across all of them.
Yeah. And then everybody will automatically just jump to their individual because just keep it simple.
Yeah. Okay. I guess we couldn't put off that discussion. Even though I thought we might. Okay, so let's get back to the bigger employer-sponsored retirement plans. So these are kind of 401ks, 403bs, 457s. Those are the big three that come to mind.
Right. So these are the standard plans if you're working for a larger company. So in this situation, it's most likely not a small business. You're at the point where you're likely an employee of one of these businesses, in which case, these are the plans that you have to choose from. And the nuances are basically the 401k is probably the most heard of, and these are just larger retirement plans for-profit companies or corporations. And what that means is it's a pretty large and robust plan. It has its own separate administrator and a lot of bureaucracy that's tied to it to keep everything fair and expensive, maybe. I don't know.
No, there's a lot of rules that they have to follow. But
there are, yeah. These are the ERISA rules I alluded to earlier of making sure that the top employees don't take most of the benefit from these types of plans. Now, there's cousins to the 401k. One of them is the 403b, and this is similar to a 401k, but it's just offered for nonprofit organizations. And, nonprofit, these corporations don't pay tax, so that it changes things a bit. So that's why the 403b is more sensible. We'll talk about the nuances in a bit.
Yes, this is usually like hospitals will be nonprofit, teachers and other school district employees tend to have 403bs. Try the other, and yeah, any like true like nonprofit organization, if it's that they would have a 403b. I'm trying to think of other places other people I might have seen have a 403b.
Yeah, basically, yeah, the institutions that are designated as this nonprofit status.
Okay.
And then the third cousin is something known as a 457, and these are for state and municipal employees, colleges and library and firemen and things like that.
Yeah, I saw a lot of police officers, government officials,
yep. Mm-hmm.
Also a lot of the teachers that work at school districts. So there's some overlap between these.
Right. So, the 401k, just to get into some of the details, we talked about that solo 401k limit of 19.5 for 2021. Well, that's the same for the 401k. And for the 403b and the 457, you're going to see similar rules that apply, but there are just nuances, and it's in the gray where things get a little different. So for the 403b, you still have that contribution limit, and same thing for the 457. However, the nuance here is that you could have a state and municipal worker who's also employed by a nonprofit. So, for example, a university employee would be employed by the state, could be employed by the state, which happens to also be a nonprofit, in which case you would have access to a 457 and a 403b. And it turns out you can contribute to both up to 18,500.
19,500.
Sorry, 19,500 for 2021. So the notion here is, yeah, if you happen to be in, this special type of employee structure, you might be able to contribute more than other employees because I guess the government says you're special.
I
But
think
there,
my now that can I get a little optimistic? I'm hoping that because they acknowledge that if you work for a nonprofit that's also a state or municipal employee, the pay tends not to be as high. So I'm hoping that this is one of those extra benefits they use to make up for that. That's my hope.
I agree. Now, there are businesses where that may not make the most sense, and there are others that may make more sense. There might be, for example, a nonprofit hospital where you have physicians, right?
Mm-hmm.
Or that might be slightly different compared to like teachers.
Yeah.
So again, there might be this understanding when the law was created, but then there's all these different areas where it gets a little hazy.
Yeah, that's true.
So in terms of these three types of plans, well, the notion is, if you have access to them, you'll want to contribute accordingly and try to max them out. Now, there are certain things to think about in terms of, for example, withdrawals. With the 401k, you're supposed to wait till you're 59 and a half. Otherwise, you suffer a 10% early withdrawal penalty unless you meet a handful of exemptions. So these exemptions include, for example, if you became permanently disabled and you need to stop working, or you have excess medical bills that could be used, if you're called for active duty, and also that there's this notion that if you're separating from an employer at age 55 or later, there are some exceptions to avoid this penalty.
You'd be considered actually retiring and therefore can take money out of your retirement plan.
Right. So there are options if you're in a standard 401k plan to withdraw early if you meet that criteria, but typically you're going to have to wait till you're 59 and a half.
Okay.
Now, for the 457, there is actually no early withdrawal penalty. You still have to, it's a pre-tax plan, so you still have to pay taxes on the withdrawals, but you won't have to pay this penalty if you withdraw your money when you're 50 or 40. So, pound for pound, you may want to consider this if you have the option to contribute to both.
So I'm curious. I've never actually had the situation where a client was asking, I can contribute to both a 403B and a 457, but I can't max them both out. Which do I contribute to? I've never thought about that. Do you have any initial thoughts that come to mind?
So it's come up with that like physician example I mentioned, and in that case, you just max out both. But so but if you did have the option, then you would make a decision like that, I would say.
Yeah. So I guess the only thing I can think of is that early contribution restriction on a 403B that may not be there for a 457. So I guess I'd lean towards a 457.
Yeah. And the decision may vary based upon other considerations. I believe there are loans that you can take out against your money you have in some of these plans, and that might be different across some of these.
Oh, that's a good point. Yeah. So probably enough other individual considerations. What the fees are on the plan, investment options. Can you do a Roth in one or both?
Right. Yeah. And there is that Mega-Backdoor Roth notion, which might get some play in some of these plans.
So we'll get to that in a second. I just realized the other kind of bigger employer-sponsored plan that comes up is the Thrift Savings Plan, the TSP, for federal employees. So
right.
I have a few family members in the military that they contribute to the Thrift Savings Plan, and this is I don't know the fees of it, but it's almost the platonic ideal of an employer-sponsored plan. The contribution limits are the same, so it's still the same 19,500 that can go in. But the investments are, if I remember off the top of my head, C fund, S fund, I fund. I think it's an F fund and a B fund, and it's basically common stock, which would be the U.S. large cap, international stock, which is the I, small cap is the S. I think F might be fixed income, and B might be balanced. I might be getting my acronyms incorrect, but it's like all thrift savings plans for all federal employees have a limited number of funds. Plus, they also have target date funds. So they might call them life cycle funds. I forget the exact phrasing, but they all have the same target date funds as well that are just combinations of those 5 funds. So it really makes your decision-making process a lot easier. It also looks weird, like if I have a client who has a TSP and I'm giving them their allocation, it's just 3 funds. Okay, you're gonna invest in your C, your S, and your I. And it's like, really? That's it? Like, yep, that's all you need. So, but yeah, the thrift savings plans is another one that is another cousin to 457, 403B, and 401k.
Right. And so, so far what we mentioned were those employee contributions. A good perk with a bunch of these plans is you have an employer contribution, which is typically a match up to a few percent of the employee salary. And, what that does mean is it is free money. If you think about it from that perspective, if your employer is going to match 3% of your 3%, you should definitely put in it would make a lot of sense to put in your 3% to get that extra 3% from your employer, which you would not get. And then, if your employer is really nice, then they could max it out on your behalf, in which case you would get back to that 58,000.
Okay, so I think before we get there, I think we need to discuss Roth conversions and a backdoor Roth. Kind of bringing back to what we talked about on your soapbox. This is related to the conversation we've had in the past with Roth IRAs, where if you put money in a traditional IRA, it's pre-tax. Put money in the Roth IRA, it's after tax, and the growth is tax-free. There are income restrictions on what you can contribute to the Roth IRA. So if you make more than, I think it's like 198 this year is around the phase out as married filing jointly, you can no longer contribute to a Roth IRA. But based on I think it's the Tax Cut and Jobs Act that changed it, there are no income restrictions on Roth converting from a traditional IRA to a Roth IRA. And so now this has merged what's called a backdoor Roth. You contribute to a traditional IRA, but you make a non-deductible or an after-tax contribution, because there's actually also income restrictions on deductions to traditional IRAs. That's a higher number. I don't know that off the top of my head, but there are income restrictions to non-deductible contributions to traditional IRA. But there are no income restrictions on the contribution. There's only income restrictions on the deductibility. So if you make too much, you can always contribute to the traditional IRA, whether that's deductible or not, depending on your income. But if it's not deductible, you make that contribution, then you convert that after-tax traditional IRA to a Roth IRA. And if you do it about the same time, or just it wasn't invested, then there may not be any growth in your non-deductible after-tax contribution. So there shouldn't be any extra taxes on the conversion. So this is a pretty common strategy now. It's called a backdoor Roth. There was a phase where it was a kind of an IRS gray area. The IRS has now given its they've written letter rulings that this is now acceptable. Even just calling it a backdoor Roth still feels unnecessary, but we can do this. A couple things to be aware of with Roth conversions is the pro rata rule, where now if you're making a Roth conversion, you don't get to choose which dollars are pre-tax or after tax. So if you have money in a pre-tax traditional IRA, and then you make an after-tax contribution, when you do a Roth conversion, you can't just convert the after-tax component of your traditional IRA. It's going to be a pro rata where if you have 90,000, let's figure, you have $54,000 in pre-tax in a traditional IRA, you add in $6,000 as an after-tax contribution. So 10% of your traditional IRA dollars is after tax, 90% is pre-tax. When you do a Roth conversion, now 90% of whatever you contribute, or whatever you convert, is going to be considered pre-tax that is now taxable, and only 10% is considered tax-free. And so this creates a planning scenario where, one, it might not make as much sense to have pre-tax money in a traditional IRA, or you might want to wait for the years when you really can convert the entire amount. Because anytime you're trying to do a partial Roth conversion, if you have both pre-tax and after-tax dollars in a traditional IRA, it probably doesn't make as much sense because it's going to be mostly taxable upon that conversion. So this could be things like rolling over your pre-tax traditional IRA dollars to a 401k, to your existing 401k. Again, if the 401k plan allows it, because there's a lot, everything related to 401ks is if the 401k plan allows it. But now the 401k dollars are not part of that pro rata rule. Other components could be just trying to do those Roth conversions as much as possible, as early as possible. So you kind of don't have pre-tax dollars in a traditional IRA. You can always make that kind of, if all of your money's always in a Roth, you do that after-tax contribution traditional IRA, convert the entire amount. So that's another way that you can kind of manage that pro rata rule. But if you understand, again, the backdoor Roth, the Roth conversion, making the after-tax contributions, converting that to a Roth, which would be a non-taxable event because the dollars were already after tax. And you understand what we talked about with 401ks of employee contributions and then employer contributions up to $58,000. Again, like all 401ks, if the plan allows it, this now gives us an opportunity for what's been nicknamed the Mega-Backdoor Roth. So, Trishul, do you want to try to explain, given all the context I provided, the Mega-Backdoor Roth?
Yeah, and yeah, good insight on the actual backdoor Roth, the I guess nephew of the Mega-Backdoor Roth.
I think the backdoor
was
Roth
born...
would be an older generation. That'd be like
that's why
uncle.
I was hesitant, because but it's not mega, so it can't be bigger. So
you can have a nephew or a child that's bigger than the parent.
I guess so. Okay, so I probably should have chosen a different metaphor. So with the Mega-Backdoor Roth, the reason why it's mega is because not only with the backdoor Roth, it allows you to get a contribution of, like $6,000 that you wouldn't be able to do otherwise. Well, with the Mega-Backdoor Roth, what it does is it could potentially allow you to increase your tax sheltered amount from, maybe that 19,500 that you were able to do with your employer's 401k plan, all the way up to 58,000. Now, the nuance though is not all of that 58,000 will be pre-taxed. In fact, only the 19,500 would be pre-tax. The remainder would be post-tax. It would be similar to like a Roth. And
well, I think that's the key, is that it actually be okay. So I need to explain without a Roth conversion, a non-deductible after-tax contribution to a traditional IRA. Let's say you only contribute to a traditional IRA and you make too much money to deduct that, then the contribution amount is tracked. That is always going to be after tax. Any growth on the contribution inside a traditional IRA, that is still considered pre-tax. That would still be taxable upon withdrawal, which is why you combine it with the Roth, where if you the growth would be after tax, but the contribution is after tax, but instead of leaving it in the traditional where the growth will be taxable, you convert it to the Roth, where now the growth is tax-free. That's kind of the big distinction with that non-deductible traditional IRA contribution. And same thing here is only the 19,500 is deductible. Anything between 19.5 and 58K in 2021 would be a non-deductible after-tax contribution.
that's right. So what we're talking about here then is basically it's an after-tax contribution, but what that means is that money, once the Mega-Backdoor Roth is performed, is basically able to grow without ever paying taxes again. And the notion here is that's an extra, 38,500 you could do if you're allowed to do it. But the key is, again, your employer has to be progressive enough to have a plan that allows this type of feature. So it isn't something that's, automatically available to every employer on there. There is some hurdles that the employer has to do to set up the right type of plan. Now, the key things that the plan actually needs is the ability to make what is called a non-Roth after-tax contribution. So this is basically a voluntary contribution on the behalf of the employee with after-tax money. So taxes have already been paid. This amount goes into a separate bucket that's held by the employer's plan, holding these non-Roth voluntary after-tax contributions. And then the employer's plan also has to allow the ability for an amount that is up to 58,000 for you. For example, again, with a 401k plan, there are many rules. This is known as the ACP test that puts a cap on how much employees that are particularly highly compensated. So it's likely that if you're putting this much into a plan, you are highly compensated. So there's going to be limits so that your assets don't dominate the plan's assets. And that's where these ERISA rules that I mentioned, 2 times ago come into play once again.
One of the examples, my wife works at a company, Shutterfly, and they're located in the Bay Area, or the headquarters in the Bay Area. So a lot of the engineers do fall under those highly compensated employees. But as a company, they have printers and they have employees all over the country that provide different services, and those are lower skilled, lower paying jobs. And so there's a means test, and kind of every engineer in the Bay Area is contributing to the 401k, but not enough of the lower compensated employees are contributing to the 401k, and their 401k is considered top heavy. And so for the last 2 years, the 401k plan has had to refund contributions from the prior year, saying because not enough of the lower compensated employees contributed enough dollars in the plan, the highly compensated employees are limited in how much they can put in. So
right.
That's an example of that means testing, that ACP testing.
Mm-hmm. Yeah. So that there has to be room in the plan for you to make this contribution, and the plan must allow this special non-Roth after-tax contribution. So if these things are allowed, then you can go ahead and potentially put Well, in theory, you could put all 58,000, meaning if you don't even elect to take your deduction, maybe you don't want to take your deduction. If you're highly compensated, it's likely you're in a high tax bracket and you may want to take the deduction, but your mileage may vary on that point. But the point is, whatever you contribute to a pre-tax account, well, that gets subtracted from the 58,000, whether it's 0 up to 19.5. And then also that employer contribution, that match or whatever the employer put in on your behalf, that also gets subtracted from the 58,000. And whatever is remaining, that is what you can put into this plan. And it's effectively, if your plan allows it, you may be able to move it into a Roth component of your 401k, or you may, if your plan allows it, be able to roll it into just your Roth IRA. Depending on your plan, again, you may be able to do this even if you're still employed with this company. This is known as in-service distribution. And what that effectively means is each year you could get into your Roth IRA potentially an extra 58,000 because you happen to be employed with this very progressive employer.
Okay, so we need to have the plan has to allow the non-Roth after-tax voluntary contributions, has to pass the ACP test, then has to allow the in-plan Roth conversion, or could you do it? Could you do it to if they allowed in-service withdrawals? Would you be rolling out the after-tax contributions and converting to a Roth IRA?
So
I'm thinking about that right?
Yeah. So if they do allow that, yes.
Okay. So again, everything is with 401ks is if the plan allows it.
Right. Yeah. And you can imagine there are plans out there that have figured this out and said, okay, you can do this plan. It has everything under the sun. Here's the 1,000 pages that says,
Yeah.
Here's how it's done. And again, 58,000, not bad.
Yeah. It's I do have a couple clients who work at companies and they make too much contribute to a Roth IRA, but because their company 401k plan allows it, I believe they are doing Roth 401k contributions and they're doing the Mega-Backdoor Roth. So it's a weird, like the IRS says, oh, you make too much contribute to a Roth IRA. Oh, but your company will let you contribute 58,000 to a Roth 401k.
Right. Well, good thing we put the cap on the 6,000.
Yeah, exactly.
Air quotes on that cap.
Okay, but yeah, this is a good discussion because part of it is there are so many things. It is complex. There are a variety of benefits that you may not be aware of. If nothing else, look through your company 401k plan summary plan description, the SPD. That's the document that details everything the plan is allowing to do. But managing the pre-tax contributions, non-deductible after-tax contributions, and Roth contributions or conversions, this is where financial planning comes into play. Because like you said, if you're a highly compensated employee, you might want the deduction on the 19,500 and then the Roth conversion of the after-tax amount. But it's also possible that you might be better off with the Roth contribution if you can make it all Roth, depending on what your tax rates are, what your savings rate is, and what your future lifestyle projects to be. And those aren't easy decisions. I tend to prefer the Roth because I see it more as a forced savings. You're actually putting more dollars in when you consider the taxes than you would if you were doing pre-tax. But if your income's high enough and we think that your income will reduce in the future and your tax rates will go down in the future, pre-tax also works.
That there's like a very interesting strategy at play here where if you happen to be a high income earner presently, you take these pre-tax deductions and you contribute to, these pre-tax accounts. And then when we mentioned this before, when your income drops, well, then you do your Roth conversions at a very low tax rate, and now you get everything in the Roth. So you got the big pre-tax deductions you could have, and you got the benefit of the Roth.
Yeah. I think also this is one thing where, kind of like our conversation a couple weeks ago about fees on asset under management, even within the fee only space, moving money from a 401k to an IRA tends to allow you to reduce investment expenses, tends to give you more investment choices. But this would be an example of a situation where you don't want to roll over your old 401k to an IRA. That if you wanted to be able to make Roth conversions because of the pro rata rule, it might make sense to leave that money in the old 401k or roll it from the old 401k to the new 401k.
Right. I remember a case where we had to go through the crazy math of, oh boy, the employer's plan has crappy options and you're going to have to pay these higher fees. But let's do it to avoid the pro rata hit because, if we pull it out of that plan, then we, won't get an optimal backdoor Roth strategy. So it's, again, just one of the silly things that helps keep us employed, I guess.
Yeah. I've done a few of those of the, you could contribute to a Roth, but you make too much money. So now we have to do we have to back that out and do a removal of excess contribution to your Roth IRA. I've done that math in the past. I've done there was something else I was thinking about it wasn't the fees. I think it was actually they had already done the backdoor Roth without being aware of the pro rata rule. And so I helped them understand, okay, here, what you thought was going to be a non-taxable event is actually going to add this much to your taxes. And kind of, is it worth just, okay, let's go along with that? Or do we try to undo the Roth conversion? Because you used to be able to recharacterize that in the past. And I think just recently that's gone away. I need a little more research on that. But that was one of those like, okay, is it worth time, energy, and paperwork and kind of increasing possibility of error to get out of the taxes that you accidentally incurred on yourself?
Right.
So this was a long one. This is a bigger conversation for us.
A little bit.
And there's still so many things we kind of left off to the side.
I think we covered a lot, but yeah, this is a big area.
So this is why there's so many blog posts on retirement plans, because you need the writing, you need the text, you need to be able to actually give all the edge cases and corner situations.
Yeah, I still keep thinking back to our healthcare example with all the bureaucracy that this creates. And I really wonder how much CPA time, advisor time, employee time, employer time, just handling retirement plans ends up taking up.
So maybe this is like a self-selection aspect because of the clients I tend to work with. They are employees at companies that have stock. They're almost all 401ks. And so, it's not even because I do have to read the 401k plan description. So there is nuance there, but usually just maxing out the 401k, it's kind of enough savings for a lot of what they want to do in life. Like that's usually a high enough number. Well, no, that's not true, because sometimes if it's a savings rate of 9-10%, that's not enough. You know what? I'm gonna take that. I'm gonna take back what I didn't actually finish saying. This could be a lot easier.
Well, at least hopefully we shed some light on this topic and provided some insight on the gotchas and the nuances.
Yeah. Well, thank you for all your research, Trishul. I really appreciate it.
Thanks, Aaron. I enjoyed digging into this stuff. And thanks, everybody, for listening. If you're enjoying these conversations, do subscribe to our podcast. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.